The S&P 500, as well as many of the major averages, really moving to the upside this year. The S&P up more than 7%. A lot of this rally driven by just a handful of tech stocks, very similar to the story that we were talking about last year. So is the market nearing bubble territory, and how should you position yourself ahead of that? We want to bring in Paul Dietrich. He is the Chief Investment Strategist with B. Riley Wealth. Paul, it's good to see you here, and you lay it out pretty straightforward in your most recent note. You say that people need to be aware of the fact that we are near the bubble territory. The stock market bubble is about to burst, is exactly how you put it. So we've been seeing this dramatic run up in stocks right now. When you say it's about to burst, what's that going to look like? What should investors be doing today?
Well, I was managing money back during the dot-com bubble, and I can tell you that the stock market can go up. Even though there are no fundamentals, it's all momentum for a long period of time. But when it does burst, it usually bursts quickly. And so that's what we're looking at. I've analyzed the stock market from just about every traditional analysis that you can do to determine whether it's overvalued or undervalued. And every single indicator seems to tell us that we're in a historic bubble. But how long it can go, that's a good question, because it certainly went on longer than I expected back in 2000, 2001. And you look at things like price-earnings ratio. I mean, we haven't seen a gap between the PE for the S&P 500 and the price of the S&P 500 since the internet bubble back in 2000. And then you look at something like the 200-day moving average, and there's a 13% gap, which is historic. That's what the S&P 500 would have to go back to. It would have to drop 13% from right now to get back to its 200-day moving average. You look at other indicators and they're all the same. We're literally in historic territory. And it's hard to look at that and say that we're not going to see a major correction coming. Now is not the time to be putting new money into the market.
Paul, so when things feel bubbly like this, number one, what is the biggest indicator that you've looked at that's sent off flashing lights and signals? And does that essentially initiate a mindset for a lot of shorts to enter into this picture too?
Well, I'm sure that every analyst and chartered financial analyst is looking at all the different valuation methodologies, and they've got to come to the same conclusion because there's just no ambiguity here. It is bizarrely overvalued in most of these things. And so you're seeing the smart money right now moving massive amounts into cash. I mean, we saw Jeff Bezos sell $8 billion worth of Amazon. Zuckerberg last week sold $1 billion of Meta. It's not that they don't believe in their companies. They do. They know that it's just completely overvalued. And if they sell it now, they can buy it back cheaper later. And so the Walmart family just sold, I believe, $4.5 billion in Walmart stock. Warren Buffett has sold his stocks of the companies that he doesn't wholly own, a lot of them, and he's created a $158 billion cash hoard so that he can use that. So we're also looking at corporate cash, and it's historically at its highest level ever. So this is why, you ought to, maybe they know something that we don't know as average people.
Yeah, but then there's also the flip side that a lot of people are really questioning whether or not that even signals the end of this rally that we have seen. Paul, I want to ask you, though, in terms of what is going to trigger this correction that you are expecting, what is that one event that you think is going to cause this massive reversal?
That's a really good question. And because most of the triggers, if you look back at previous recessions, were not really anticipated. Not many people saw Lehman Brothers collapsing, and in the 2008, 2009, we didn't see the points that brought the internet bubble to where it dropped. You've got to remember the S&P dropped 49% peak to bottom after the internet bubble. And so I think that it could be a geopolitical issue. Certainly if oil prices go up, or if oil were stop being shipped through the Straits of Hormuz because of the Houthi rebels, that would increase inflation. The Fed would be forced to raise rates. That could be a trigger. I think another trigger that's quite possible is basically the refinancing of commercial real estate. There's like trillions coming up in the next 18 months that need to be refinanced. 70% of it's done by regional banks. And if you look at regional banks, they're not as well capitalized as the too big to fail banks. And all you need is, a couple of them just not having the capital if there's a run on the banks because of some of the problems they're having with the real estate that they have financed and can't be refinanced. So these are possible things. I see this. If we do have a recession, I see it as a very mild recession, very similar to the dot-com recession in 2001 and 2. People forget that was a very mild recession. We had 2 quarters of negative GDP growth, right, where we never even went down 1%. But the thing that people don't understand is that the stock market can really go down in a mild recession because the dot-com bubble was so big, and it ran up so high. Basically, you saw a 49% drop in the S&P 500.
Well, yeah, Paul. I mean, I got my praying hands emoji ready that we don't see some of those exogenous events here. We're going to be tracking it extremely closely, as we know you will as well, and any of the market implications. Paul Dietrich, who is the B. Riley Wealth Chief Investment Strategist. Paul, thanks for taking the time this morning.